Is it time to do a tax-deductible buy-sell arrangement? What is a buy-sell arrangement? How can they be tax-deductible? Hi there, my name is Kenner French and I'm with VastSolutionsGroup.com, where tax, finance, and artificial intelligence meets for entrepreneurs. Clients have said about us such things as, over the years, you have saved me approximately $1 million. Now, what does this all mean for you? One of the critical needs of a small business is to protect against the untimely death of an owner. This is important because the family of the owner may face a large tax bill and may not have the liquidity to pay the tax. To make matters worse, it may not be desirable for the deceased owner's family to have a hand in running the business. Traditionally, this problem can be solved with a well-designed buy-sell agreement. Although there are a variety of ways to structure such an arrangement, the two most common approaches are the stock redemption and the cross-purchase plan. Now, these plans are often funded with life insurance. Insurance can provide both the liquidity needed by the family to meet its tax obligations and the ready cash for the surviving owners to purchase the interest of the deceased shareholder. In a stock redemption plan, the corporation agrees to purchase or retire the stock of the deceased stockholder. Typically, the corporation purchases life insurance on each stockholder to fund the arrangement. In a cross-purchase plan, the owners agree to buy the stock of a deceased partner. To fund a cross-purchase arrangement, each owner buys life insurance on each of the co-owners. In both cases, life insurance guarantees that funds will be available if and when they are needed. A frequent obstacle to buying and buy-sell is the lack of sufficient cash required to pay for the insurance. For example, 34% tax bracket, it takes $15,000 roughly in pre-tax earnings to support a $10,000 life insurance premium. So it's not surprising that many owners ask if there's a way to deduct the cost of the insurance premium. Can this be done is the question. In fact, there is a way. By purchasing life insurance through what's called a profit-sharing plan, which is sponsored by the business. When properly structured, the funding of a cross-purchase plan in this manner has all the advantages of a traditional buy-sell arrangement, with the added benefit of income tax leverage to purchase or to reduce the owner's out-of-pocket costs. A little background will help. The IRS, Internal Revenue Service, defines a qualified plan as a profit-sharing plan as a plan that does deferred compensation, creates flexibility that is not available within a qualified pension plan. Amounts allocated to the profit-sharing plan account of a participant may be used to provide incidental life insurance protection for himself or anyone for whom the participant has an insurable interest. The IRS has agreed in private letter rulings that this regulation supports the purchase of life insurance of a co-shareholder to fund a cross-purchase arrangement. Now, the specifics are very nice to know. Generally, in designing such an arrangement, the following conditions must be met. A plan must be a tax-qualified profit-sharing plan, without a doubt. This plan will allow each participant to direct a portion of his or her account towards the purchase of life insurance. This plan should provide that participants may purchase life insurance on themselves or on the life of any individual in whom they have an insurable interest. Now, one thing to think about, the purchase of life insurance must meet the so-called incidental death benefit limitations. Taxable insurance costs, or PS58 costs, must be reported by the participant to whose account is supporting the cost of the life insurance. A lot of plans don't do that. If the participant is married, the spouse of the participant should consent in writing to the use of a profit-sharing plan fund in this manner. Otherwise, it negates the philosophy. At death, the amount at risk under the policy may be distributed immediately to the surviving shareholder. This amount is received free of income tax and may be used to satisfy the buy-sell agreement. The cash value portion of the policy should remain in the profit-sharing plan. Otherwise, it's not possible. The funding of the cross-purchase arrangement through a profit-sharing plan in this manner may work best for small, closely held businesses with 2 or 3 owners. But It can work in larger businesses as well. And this approach may provide a cost-effective means of purchasing life insurance. This is an important consideration for any business that may not otherwise have the ability to fund the buy-sell plan. Now, one last thing I want to convince you of or make note of. We do this on a daily basis. We know exactly what it is that can help an entrepreneur. We've been doing this for 50 years and we're going to continue to do this for another 50 years. Now, if you do need help, consultation, etc., please look us up on the web at www.vastsolutionsgroup.com or give us a call at 888-808-VAST, which is 8278. Once again, my name is Kenner French. It's indeed been a pleasure. Hopefully in some way we'll be able to help you. Thank you.